Hello, I'm Michael Hainsworth. Gold has been called everything from a barbarous relic to the ultimate insurance policy. But for investors trying to protect their wealth in an age of inflation, deficits, and uncertainty, it's anything but old-fashioned. Joining us are Robert Cohen and Emily Griffiths. Together, they've built a reputation on Bay Street for navigating the often misunderstood world of bullion, not just the metal itself, but the companies that pull it from the ground. And they've got the background to back it up. You said you are a geologist?
Yes,
Oh, okay, so hang on. Are you married by any chance?
I am married, yes.
When the ring went on your finger, how much pressure were they under?
A lot of geologists, I would say, don't want diamond rings, but I went for a diamond. My husband did a good job choosing, so props to him.
Still to come, in an age of uncertainty, all that glisters is gold. But first, we've all heard the phrase, all that glisters is not gold. But for risk-adverse investors, it's often seen as the only source of safety in uncertain times, going all the way back to when Shakespeare penned that phrase in the 16th century. When times are good, investors tend to favor stocks. When times are bad, they tend to buy gold. During the 2020 stock market crash, stock investors lost $1.30 for every $10 they invested. That year, gold's value surged 25%. But the problem is, the relationship between good times and bad, stocks versus gold, doesn't always add up. Between 2011 and 2015, the Toronto Stock Exchange rose only 11%, but the value of gold in that same time fell nearly 40%. Today, some argue gold is more hype than hedge. Alternative assets, including cryptocurrencies and inflation-protected bonds, now vie for attention, promising similar shelter with potentially higher returns. Gold still offers comfort during market turbulence, but it's no longer the only game in town, nor is it a guaranteed hedge. While there is plenty of glister elsewhere, gold still has its place in a well-diversified portfolio. A dollar buys just 1% of what it did a century ago. But gold has held its value over time, and today is near an all-time high. To understand how much bullion I should have in my portfolio, I began my conversation with Robert and Emily by discussing how the erosion of purchasing power has shaped gold's role over time.
Well, you're always going to have deflation of monetary assets. So a dollar in 100 years from now will probably buy 1/100th of what it bought today. Gold is probably your quintessential monetary asset. It's withstood millennia of value as a monetary asset. It's the only metal used by central banks around the world to back their foreign exchange reserves.
Before we go any further, I think we need to get this out of the way. Grammatically speaking, maybe, Emily, you've got some insights into this. Is it glitter or glister? Because as I understand it, all that glisters is not gold, but that's not what this conversation's about, because it is all about gold right now.
Yeah, I mean, I think in today's world, all that glitters is gold. We've seen, especially in the last 5 years, unprecedented global monetary policy, money supply expansion, and gold has withheld its value while all the fiat currencies have devalued.
You mentioned an interesting point, Robert, about how governments have approached gold in the past and how they're doing so now. Historically speaking, how have they treated the money supply through history as it relates to bullion?
Very poorly, especially in the last few decades. Governments do not revere the importance of monetary policy. They do not respect the money supply. For example, during COVID, governments around the world printed a lot of money to do their helicopter handouts. But that massive doubling of money supply, it has an effect. You've devalued the paper money behind it by half. So this is why we've seen so much inflation coming through. And you might recall in the early days of inflation, the governments were using lines on us like, oh, don't worry, it's transitory. What is transitory inflation? No idea. So if you want to really have your your purchasing power protected, you need to own gold.
And they've returned to gold as a core monetary asset. Have we not? After decades of favoring T-bills, Emily, central banks are starting to find religion on gold again.
Yeah, for the first time in around 30 years, gold has surpassed the T-bills in as a percentage of foreign reserves. So we've seen a lot of buying out of China, Poland, Singapore, Turkey, India. A lot of the Eastern central banks have, seen the light and are more interested in backing with something physical than the US dollar T-bills. And I think it just points to deteriorating credibility in the US dollar and the debt that, the US is not going to be able to pay back unless they inflate their way out of it. And gold's, coming back as this asset that we can rely on over time.
I want to get your take on the debt component to the gold trade. But before we get into that, let's sort of wrap up our sort of history lesson, as it were, about talking about why history matters when we look at gold, considering it is at all-time highs right now, Robert.
I think we have to get out of the mindset that, oh my God, it's had this great run and this has got to be it. I think people have lost sight of what gold is, especially in the 90s, when you were worried about the formation of the new euro and rumors of European central banks no longer including gold as an asset, England selling their gold in advance of that, and they were just worried that gold was an old financial relic. Not the case. That was just a really, call it in the big scheme of world history, that was just like a blip where people were thinking, oh, the US dollar is going to be the quintessential monetary asset going forward. Things change, but gold does not. If you look at the history of gold, 187,000 tons of gold has been mined in the history of the world. We mine, I think, is around 3,000, 4,000 tons a year. So you're looking at, if it were a monetary supply, you're only increasing it by 1.5% per annum versus paper money, fiat money, that increases at a much faster rate. So you really need to look at gold from the perspective of not how far we've come, but where we're going.
Okay, so gold has held its value while paper currencies have steadily lost purchasing power. Robert believes governments have treated the money supply as disposable and flexible, printing money freely, basically fueling inflation along the way. But after favoring treasuries, it appears gold is back in favor as a core monetary asset for some, but not among everyone. Help me understand why gold is so misunderstood. Why do so many investors dismiss bullion as topping out?
I think that a lot of investors want to believe that the world's improving. So, for a long time, we had the peace era. There weren't, any global conflicts happening. We also had periods of disinflation in goods with, China joining the World Trade Organization. And so we did have a period where it was a relatively peaceful, calm time. But that's not the case anymore. And, now we have as many countries involved in conflicts as we did during World War II. We are also seeing a deglobalization event happening with tariffs and additional inflation, and we're at all-time highs for global debt. So I think people are just hesitant and maybe anchoring themselves with psychological biases to believe that their assumptions don't have to change, but really the macro drivers behind this move in gold and the support behind gold have changed. So people haven't quite adjusted their psychology yet, but I think that that's starting to change, and we're seeing it in the gold price and gold equities.
As far as the debt component to this conversation is concerned, while we are at all-time highs around the world for sovereign debt, it's only getting higher from this point forward, and the U.S. seems to be driving the bus on that. Robert, what does that tell us about the macro drivers for gold for the future? And what are some of the other ones? Because it's not just debt. We have to talk about interest rates. We have to talk about the volatile economic environment in which we find ourselves.
about debt, we are at all-time highs. It's not just debt, it's debt service costs. And even with interest rates being bumped down 25 basis points here or 25 basis points there, it does not change the expansion of debt service costs. So, the current monetary system that we live in has only been around since 1971. We are pushing the limits of what we know, what it can do and what it can absorb. That is one reason why gold has gone up. There is a wall of worry about, something really cracking. You have to look at that also along with real rates. So as real rates go negative, very simplistically, I'm not an economist, but there's two types of inflation. There's inflation from a robust economy and full employment and inflation coming that way. Well, we don't see that very often. Inflation's coming from monetary reflation. It's stemming from government policy and printing of money. And as I said, the disrespect of money supply. So you really want to protect yourself against government policy. If you believe governments, you're going to wake up tomorrow and the budgets are going to be balanced and debt's going to go down, you don't want to own gold. So you have basically 99 reasons versus one to own gold. There's just very few negatives pointing toward gold. Modern portfolio theory, I think in recent years, a lot of advisors go, for a very balanced portfolio, they used to say 60% equities, 40% bonds. Okay, I'm done. Now there's a lot of talk saying, gold should be at least 10% of a portfolio, active gold, meaning gold equities being another 15% of the portfolio. Some people are even throwing Bitcoin in there, but I think you'll get the same effects with Bitcoin as you will with gold, if not better with gold. Gold's a real thing that's tangible. We know where it is at all times. And then, there's also an opportunity with gold equities. And that's where you really get in a benefit from Emily's and my expertise. We both came from the mining business. So when we're looking at gold companies, we're really trying to cherry pick the creme de la creme of not just producers, but development and exploration companies that will have the new discoveries. That's creating alpha. That's finding value for free. Where if you own a brick of gold, you own a brick of gold. You're not going to get any extra additional upside. You just got beta to the gold price. So that's the reason why you would want to own a managed fund.
Okay, so that's a smart money kind of answer. But Emily, help me understand this, because I thought I had seen something recently that had said something along the lines of 3 out of 4 financial advisors are resistant to gold at this point. Why?
I think it's because they're afraid of, perceived volatility. They think it's too risky. But really, it comes down to not fully understanding either the macro drivers or the business, the mining businesses as a whole, and then honestly being hesitant to learn about it or refusing to learn about it. So, currently the benchmark is almost 12% precious metals exposure, but a lot of advisors, we from the data I've seen, are around 5 or 6%. A lot of them don't hold any at all. Like you said, maybe 3 out of 4 have any exposure. So, I think they're hoping that maybe this bull market turns around, but hope isn't a strategy. I think it's just a lack of education on it and a lack of willingness to maybe change from what they're used to.
So I'm thinking, investors, they're focused on chasing returns. They're avoidant when it comes to the idea of even a single loss, and they're following the herd.
Yeah, advisors always feel like they have a responsibility to time the market. Timing the market will often kill you. Owning gold is like buying insurance. You sort of hope that you don't need it, but here in this case, we're seeing, fabulous returns, because gold is doing what it's supposed to do. And to just toss the baby out with the bathwater is, a little ridiculous. I think advisors and investors need to think more about that long-term buy and hold strategy. As an example, I know of one advisor where the client, something like 25 years ago, put something like $2 or $3 million into the fund. Because the client didn't touch it, left it alone, kept her hands off of it, is now worth in that $60 to $80 million. And this could be the only person in Canada that I'm aware of that did that. But I think that was really, really astute, very smart not to touch it. If you're talking about gold being at all-time highs today, I would be hard-pressed to meet anyone who's ever said, oh boy, am I glad I sold my gold? Because that answer would be thrown out right now. There would be no one out there that would say, oh boy, I'm glad I sold my gold. So keep that in mind. It's still moving upward. And it's not really so much the gold price moving up. It's the purchasing power of the dollar falling. So instead of thinking dollars per ounce, think ounces per dollar. You're getting fewer ounces per dollar invested as the currency deteriorates. So the best way to think of it is gold does nothing. I'm actually betting against bad monetary policy continuing.
Okay, so if people prefer to believe that the world is getting better rather than more uncertain, that's good news for those of us who know differently. Not only is the United States racking up debt like a teenager with their first credit card, but the world is. And interest rates are now negative when you talk about real rates. Volatility is high, and interest rate cuts are fueling stagflation fears. But if 1 out of every 10 investable dollars should be put towards gold, what should that look like? If you're recommending 10% of a model portfolio have gold in it, are we talking commodities or are we talking equities?
I think you could have, both for sure. It really depends on your risk tolerance. Having a little bit of gold bullion exposure, I think, is great, but really to get the leverage to the gold price, you're going to want to have a majority of it be equity exposure. So what we've seen in the last about 6 months is the gold equities have really taken off compared to the gold price because costs have leveled off. There's not as much inflation. And, there's just been massive margin expansion in the industry as a whole. And so we're seeing that outperformance in the equities.
Where are we on the appreciation in the value of the commodity versus the equity stock price appreciation? Are we able to say high quality names are still where it's at, or do we want to go a little more down market that maybe they haven't seen the same kind of gains that the high end players have?
For the long-term returns, we are still very focused on quality names and high potential exploration companies. A big part of that is going to be the management teams. In the event of a downturn, the high qualities will still outperform the dash for trash, as we like to say. We're sticking to our knitting. We're focusing on the operational expertise of these companies, using our background, our technical backgrounds, and then really cherry picking the best of the best from the exploration landscape.
Well, then let's lean on that background. Robert, how do you define quality?
Quality could be a number of things. It could be first of all, just technically, quality of the deposit. How good is this deposit? Is it top left-hand corner, world-class ore body? You got to look at the location. Would I be happy mining in a safe jurisdiction like Canada, United States, Australia, Finland over other riskier jurisdictions? So we will also have a favoritism toward that. We've come from the industry. We've been on the street quite a few years. We know a lot of the personalities. So we know people that can execute well, some people that are more challenged to execute. And that could be anything from permitting to just logistics, anything like that. We have a penchant for Australian stocks because after Canada, the second most important market for gold stocks is Australia. I liken Western Australia to what Nevada would have looked like 50 years ago when we didn't know much about it. And you have great territory there, full of gold, underexplored. And unlike Canada, it's flat and dry 11 months of the year. It doesn't rain, so you can build a landing strip, you can access the property and do the work almost all year round. Canada, if you look it up close, I think there's over 2 million lakes in Canada. We have bad winters. We have land access issues. So you can get a lot more done in Australia in a relative same amount of time as what you can do in Canada. But some of our favorite deposits that have been discovered are actually here at home in Canada. So we still like both. And I think one thing to keep in mind is Emily and I will often see these new discoveries long before the big companies see them or know about them. So we will be taking investment positions in these names long before these companies have even heard of them. So I think that's one important thing is the two of us are living, eating, breathing the mining sector all day, and call it all day and all night because we are so active in Australia. And that's our MO, is to provide investors with something that you can't quite do from your armchair at home.
So when it comes to making decisions about who you want to invest in, Emily, give me the understanding as to how you go about determining who to buy when it comes to, say, exploration and development companies versus longstanding producers.
I'll start with the producers first. I think looking at their assets, looking at the management team, really thinking about where their potential for growth is, who's has the highest margin, what jurisdictions they're operating in, all of these things. Rob and I spend all day thinking about and comparing different producers. Another large part of it would be capital allocation. It's not just us investing our dollars into their shares. Like, they have to take that money that they're making and invest it in, or maybe organic growth or potential M&A, like something that actually adds value to the business as a whole, rather than growing for the sake of growing, which we've seen in past cycles. So we're really focused on those producers. From an exploration and development standpoint, it's more the geological potential of the assets and their ability to execute. So Rob mentioned, in Canada, logistics can be challenging, weather can be challenging. So we really have to think about all these different aspects that go into that, and even the cost of exploration or development, because certain jurisdictions will be lower cost. They'll be able to get, more drill holes in the ground, more news flow happening, keeping the market and honestly potential for discovery higher because they can do more with the dollar. So so it's a combination of all of those different things. But I mean, I'm a geologist by background, so I'm always going to say probably the asset is one of the most important things, or the most important thing, to have that geological potential, to have something, potentially tier 1, or something that can actually turn into a mine one day. And then second to that would be management that's not going to, steer it off path and actually develop the potential of that asset.
So then, with that in mind, particularly with the idea that a model portfolio should include 10% in gold, what's the one thing you want the listener to remember about our time together today?
I think to remember that gold is a very important part of portfolio construction. To be naked gold is doing yourself a disservice. You need to recognize that as debt and financial crises, geopolitical crises are alive and well, you need to own gold to diversify your portfolio.
To really get that leverage to the gold price, we obviously recommend, getting some gold equity exposure and really maximizing that benefit.
Thank you so much for your time and your insight today.
Thank you.
You're very welcome. Thanks for having us.
Gold has been dismissed as outdated, misunderstood, as speculative, and ignored by too many advisors chasing the next hot trend. But history tells a different story, one where gold's role as a store of value outlasts governments, currencies, and economic cycles. Robert and Emily remind us that this isn't about timing the top. It's about owning an asset that protects against the erosion of wealth and the uncertainty of tomorrow. For those willing to look deeper, evaluating gold stocks isn't just about the shiny commodity, but about the quality of the companies behind it. And as central banks rediscover their faith in bars and ounces, the smart money is too. And now you're on the money. I'm Michael Hainsworth. If you're not already subscribed, you can find the On the Money podcast in your grocer's dairy case or wherever fine podcasts are found. Thanks for joining us.